Hey, my Empowered Visionaries. My name is Shamira K. Shepherd. I'm a purpose coach, speaker, and entrepreneur. I empower professional women to tap into their true selves and uniqueness to pursue careers aligned with their purpose. On this channel, I also provide information on the process of homeownership to help build stability, legacy, longevity, and possibly financial freedom. Now, disclaimer, I am not a credit repair specialist, a mortgage or loan officer, or a realtor or broker. I am just someone who used the USDA single family housing 502 direct program to purchase my first home, and I'm here to share my knowledge and experience. Now, the information I provide is high level information, so you'll want to make sure that you consult with your lender on any state specifics or any specifics related to your unique situation. So let's get into it. Now, the first thing that you will want to do is determine what type of loan that you would like to get. So whether that be conventional, which is not backed by the government, or a government-backed loan, which is VA, FHA, or USDA. Now, there's many different things that you will want to consider when determining what type of loan that you would like to go with, but I'm going to focus on the three that I think are important, and that is the credit score requirement, down payment, and closing costs. Now, with conventional loans, as I stated, they're not backed by the government. You would obtain that through, through a bank, a credit union, or a mortgage company. Their credit score requirement is about 620. Some lenders may require higher than that. And you also may want your credit score to be higher than a 620 to try to get the best interest rate. Their down payment requirement is usually about 3 to 20%. But if you pay less than 20%, you will have to pay private mortgage insurance, also known as PMI. And it's usually like an annual percentage or annual amount that you break into. They will break into smaller installments, and you would typically just pay that with your monthly mortgage payment. As far as closing costs, it's usually about 2 to 6% of your loan amount. Now, with VA, like I said, discussing the government-backed loans, VA, there is no minimum credit score requirement. Down payment is not required. Their closing cost is usually about 1 to 6%. They do have what they call like seller concessions, where like the seller can pay up to 4% of your closing costs. So that's always great. Now, VA does not have private mortgage insurance, and in all actuality, private mortgage insurance is only applicable to conventional loans. But there's also something called mortgage insurance premium, also known as MIP. But again, VA does not have that either. But they do have what they call a VA funding fee, which is about 2.15%, and you'll pay that unless you're exempt.
I forgot to mention that VA loans are only for eligible veterans, active duty military, National Guard personnel, reservists, and qualifying surviving spouses, which does not apply to me, but if you fall under one of these categories, this will be a great option for you.
Now, with FHA, they do require a down payment of 3.5%. Now, their credit score requirement minimum is 580. And you'll pay the 3.5% down with a 580 credit score or better. They will accept a credit score, or can accept a credit score between 500 and 579, but you will have to put a down payment of 10% down. Now, VA, their closing costs typically aligns with conventional, about 2 to 6% of your loan amount. They now FHA, they do require mortgage insurance. So MIP, they do require that. I believe it's the same thing. Like if you're paying 20% or more on your 20% or more for your closing costs, then you won't have to pay the mortgage insurance. But if you pay less than 20%, you will. And let's just say you put like at least 10% down, then that will determine like how long you have to pay. So if you put at least like 10%, then you may only have to pay it for like 11 years. But say you just put the typical 3.5% down, then you might have to pay it for the duration of the loan. So just all depends. Now with USDA, now you have the USDA guaranteed and the USDA 502 direct loan. Now the requirements for both are pretty similar. It doesn't require a down payment. As far as closing costs, again, it's typical like with any other, about maybe 2 to 6% for closing costs. The minimum credit score is, I'll say the preferred credit score is 640, because USDA actually has no requirement for credit score. You can have a 580, you can have a 500, but if it is less than a 640, it will require manual underwriting, and then they would have to look at your credit history. Now, if you have at least a 640 or better, it'll go through like a streamlined process where you basically don't have to do, all the extra. So it's best to have at least a 640 to go through the streamlined process. Otherwise, they'll just have to delve a little deeper into your credit history. Now USDA Direct does not require mortgage insurance. Neither does USDA Guaranteed, but the USDA Guaranteed does require like an annual guaranteed fee. So that's something to consider. Now, the deal breaker for me here is why I decided to go with the USDA 502 Direct program amongst all the other ones, is because as a single mother with 3 kids, I love the fact that I didn't have to put down a down payment. But one of the most important things for me is that the USDA 502 Direct loan offers a subsidy on your mortgage. And then one thing that I did find out like later, so it wasn't until I actually went through the process, is that with your closing costs, they can tie your closing costs into your loan. So for me, I did not have to put nothing down. I also didn't have to put up any money for closing costs out of pocket. They tied it into my loan. So that's why I decided to go with the USDA 502 Direct. But of course, as I stated, you will want to definitely examine each loan option or type and determine what will be the best option for you. Okay, so once you've determined which type of loan you would like to go with, then you would definitely want to move on to the next step in the process, and that's working on your credit. So of course, since I chose the USDA Single Family Housing 502 Direct program, these are the steps that I took. So when we're talking about credit, one of the first things you will want to determine is if you want to work on your own credit, or if you want to hire on a credit company or credit repair specialist. Personally, I worked on my own credit. Now, if you have foreclosures, bankruptcies, repossessions, that type of stuff, you may want assistance with that, but my credit wasn't that bad. I had a few things on my credit that needed some attention. There were some things that got added later as well, but it wasn't anything really major. So again, I decided to work on my own credit. So one of the first things that I had to do was get my credit reports. I had to see what was on my credit. So I was able to get a free copy of my credit reports from all 3 major credit bureaus, which is Equifax, TransUnion, and Experian, off of annualcreditreport.com. You get a free copy from each credit bureau once a year. So they don't show you your credit scores. You have to pay for that. But the most important thing is your credit reports, because that's what's driving your score. So before you can even really look at your score, you have to know what's driving it. So you would need to make sure you're getting a copy of all of your credit reports. If you already monitor your credit somehow through, maybe each of the credit bureaus themselves, that's great. But me, I wasn't. So that was the first step, is getting my reports from all 3 major credit bureaus. You're also you're going to want to monitor your credit. So We all know Credit Karma. Okay, that's one of the best ways to monitor your credit. We're not really looking at credit score. Again, we all know Credit Karma does not provide the most accurate credit score. Okay, it is a legitimate credit score, but it is not the credit score that lenders look at. So you're just, utilizing Credit Karma to monitor your credit. Anytime changes are being made, or just seeing what's on there, that's a great way to monitor it, because Credit Karma only shows Equifax and TransUnion. I also downloaded the Experian app. So I have the Experian app. Also, I use CreditWise. You can also monitor your credit through your bank. I have Wells Fargo. I'm able to see my FICO score on my app, on my Wells Fargo app. I mean, there's so many different apps these days that allow you to see your credit score, but the most important thing for me is being able to monitor the credit, like what's on there. And I think CreditWise, Experian app, and Credit Karma does well with that. Now, some of the stuff that I took in order to boost my credit, in order for me to, once I, saw what was on there, there were some things that I did, and one of the first things I did was got a credit card. I had never had a credit card before. I believe it was 2019. I applied for a Capital One credit card. I had been told about it previously, and so I decided to apply for the Capital One credit card, and they gave me a $300 credit limit. Okay, that's really low, but I took it. And I told myself anyways that I would only use it for something really small. I didn't want to go pay my light bill or something that was going to be like $200 and $250 on a $300 credit limit. So I'm thinking, okay, well, maybe I'll just put my gas on there, and I'll, pay for my gas and pay it back right away. And I'll just keep doing that. So I knew I had to pay for gas roughly like, with my commute back and forth to work every week and a half to 2 weeks. So pay for the gas, pay it back. So I think that's a great way. If you already have a credit card, and say you have one with Capital One and you have your $300 credit limit, you can always ask for them to increase your credit limit. Whether if it's Capital One or any other credit card that you have, that's an option to increase your credit line. You can also become an authorized user on somebody else's credit card. So that is a great way. I also got a credit builder account through Self. And so I can't really remember exactly how it went, but I want to say it was more like a secured loan. I chose an option. I think you can kind of choose how you would like for it to, how much money you want them to take out of your account, maybe for how long. I chose for them to take out $35 out of my account every month for 2 years. So every month that they were able to get a successful payment from me and they will put it into my credit builder account, they would then report the on-time payments to the major credit bureaus. So I did that for 2 years. So that is a great way. That's called Self. I'll put a link below. There's also, you can do Kickoff. Credit Karma also has a credit builder account. I learned about that later, but that's also an option. So of course, you would want to pay your bills on time. Through this process, the last thing you want to do as you're trying to build your credit is, have late payments or collections and all of that being added to your account. So you definitely want to continue to pay your bills on time. You definitely want to not apply for additional credit. But we know things happen, right? I mean, I don't know. You could get into a car accident and say you didn't have comprehensive for collision and you just had liability. You get into a car accident, you total your car. Now you have to get another car. You have to finance another vehicle. So things happen, but just not out here frivolously doing things. You're just applying for credit just because, you have a goal. You're trying to purchase a home. You're working on your credit. The last thing you want to do is just, apply for all of these, different, all this different credit. Some other things you can do is dispute accounts. I did that. I actually disputed some stuff. But it's always recommended that you don't dispute through like Credit Karma, that you send a letter, to the major credit bureaus regarding any inaccuracies or whatever. Again, as I stated, I'm not a credit repair specialist. I'm only just advising you of some of the things that I did. So you would definitely want to maybe dispute some things. You may have to pay some collections. Unfortunately, I had to pay like a collection or two. I was trying to make sure I was doing everything possible, and once I kind of exhausted myself and stretched myself out to my limits of what I could actually do, I did have to pay like a couple of the collections. After trying to work with the original creditors, but it didn't quite work out with getting it removed. So I've had to pay it off. So sometimes you have to do what you have to do. But the bottom line is you just want to make sure that you are monitoring and paying attention to your credit. Something else that I did to help me is I joined a Facebook group. It's I think they still have it. It's called Credit Warrior. Each one teach one. I joined this Facebook group. They post a lot of different tips, great tips. And it's a lot of people who are posting their personal stories as well. So joining Facebook groups is always good too. Again, if you're working on your own credit, these are some things that you can do. One of the other things that I did was through the Experian app, I was able to boost my credit. So I was able to connect to my bank account, and they were able to, I guess they were monitoring like my rent, my Netflix account, I think my utilities, and my phone bill. And so as I paid those bills every month, and since my bank account was connected to it, as they saw these like on-time payments every month, that would help boost my credit. So that definitely helped with the Experian. But the bottom line is, again, it's really important that you pay attention to your credit. You working on your credit. Even if you hire a credit repair specialist or someone to work on your credit, you still want to monitor your credit. You still want to make sure that they're doing what they're supposed to do. You know what's going on. You're asking the questions. You're still involving yourself in that process, and not just leaving it up to someone else to like take over and do everything for you. Okay, so the next step in the process, let's talk money. So, of course, as you're going through the process of working on your credit, you're going to want to also make sure that you have the money for the home buying process. Now, mind you, I did say that USDA does not require a down payment, and they can tie your closing costs into your loan. So I know you're probably thinking like, well, what am I going to need money for? Well, of course, that's a great question. You're going to need money for quite a few different things. But let me just back up a little bit. So although USDA states no down payment is required, that is generally speaking, but of course there's always fine print. I believe there is a situation where if you have assets, that they may have to consider those assets. Also, USDA will only pay up to the appraised value of your home. So if say for instance, if the seller or the building company is asking for $250,000, but the home only appraises at $240,000, then, and if this is a house that you want, you're going to be on the hook for the additional $10,000. So just something to keep in mind. But also on the flip side, when it comes to closing costs, so as I stated, they can tie your closing costs into your loan. But this kind of falls within the same as like the down payment. If USDA approves you for $250,000, you don't want to go find a house that's like $248,000 that's really close, and then say your closing costs are like $7,000, and then you're on a hook to have to pay the additional $5,000, right? So you want this to work in your favor. So if they approve you for $250,000, I would say you want to give yourself at least like a $10,000 difference. Now, it obviously depends on the state you're in, maybe the particular area. But these are things to consider. You may want to, evaluate the situation at hand. Once you've maybe been approved, you can have that conversation with your loan officer or loan specialist to determine, maybe what the best option is for you, or, obviously, a realtor as well, if you work with a realtor. So just some things to keep in mind. But other than that, if, none of those situations apply, we're just kind of going in this straight in. So of course, we know that during that process of building your credit and, saving money and all of that stuff, there's, expenses that you're going to be kicking out. Like I said, I had to pay some collections. And there could be other expenses just to kind of get yourself caught up with bills or whatever during like that initial process. But once you get to that point of actually applying for USDA, you would want to make sure that you consider quite a few different things here. So I got some stuff over here on my laptop I'm gonna be looking over just to make sure I'm hitting all the points. So we're gonna discuss like pre-home ownership and post-home ownership. Okay, now what I will say is I did not save up any money. Okay, I used my income tax and my 401k. Okay, so if you feel like, if you don't have a 401k, you may work a job, but you don't have a 401k or, pension or whatever the case may be. You don't get much back from income tax. Like, it just depends on the situation. And you may have to save up some money. Then of course you will want to, find some ways to be strategic with doing that. But once I kind of got my finances in order, I already knew like, okay, I'm going to take a withdrawal or a loan from my 401k, and I'm going to utilize some of my tax money. So that's what I personally did. But anytime, if you're thinking about purchasing a house, it's not just about the expenses that you have to deal with like before you purchase the house. You have to make sure you can handle the expenses after you purchase the house as well. So these things need to be considered before you decide to apply. Can you handle, all of the expenses that you currently have now, because you're still going to have those expenses when you move into your home, but all the additional expenses that's going to come along with that as well. So some of the things to consider, like pre-home ownership, is the credit report fee. That's $25, and you're going to have to pay that at the time of submitting your application. Also, a homeowner's class. If you're a first-time homeowner, you have to take the homeowner's class. I had to pay $60 for that. Your unearnest money deposit to the seller or the building company. So it all depends. It can be a percentage. Sometimes it's like 1% of the asking price, or it's a flat dollar amount. So something to keep in mind. Your first year homeowner's insurance has to be paid up front. Most likely you're going to have an escrow account. So after you close, then your escrow account, or at the time of closing or whatever, your escrow account will be set up, and then your taxes, insurance, and your mortgage, all of that will be all in one. But for the first year, you're going to have to pay that up front. And I believe mine was about $1,300 or $1,400 for the whole year. Then you have your home inspection. So depending on the area that you live in, depending on how big your house is, you're going to have to get an inspection on your house. It is highly recommended, and you may even have to with USDA. I can't remember, but I knew I wanted to get it, so I did it on my own. I had to pay $500. This is on a single story, 3-bedroom, 2-bath house. Okay, and I had to pay a 1,400 square footage, $500 for the home inspection. Because USDA does require that you move into a rural area, that's something else that you have to consider. That's an option for you, but you have to move. That's so mandatory that you move into a rural area. So, and the house that I ended up purchasing, I had to get a septic inspection on this house, which was $225. Okay. A well inspection. So I have a community well, so I didn't have to pay for an inspection on the well. I did have to provide like reports, find the company who's over the well, provide reports and all of that. But if you have like a personal well on the property, then you're depending on when was the last time an inspection had been done, if you can't obtain reports from the seller or whatever, or if it's been too long, you're probably going to have to get an inspection on the well. Realtor fee. Now, when the buyer's agent split the commissions with not the buyer, the seller's agent split the commission with my agent. So now that might not always be the case. Typically, that's what I'm aware of, but there are situations where you may be on the hook or be responsible for the buyer's agent or your agent fee. So it's just something that you definitely want to make sure you're aware of before you go into a contract or start working with a realtor, as far as if you have to kick out expenses for them or will the seller pay their commissions? Any other unexpected expenses, like say you don't close on your home, but you've already paid a deposit for a home inspection. That actually happened to me. I have a whole story on my process, on my home buying process, but that happened on, I think, 2 homes that I had. Well, actually, it actually happened with 2, but I got my deposit back on one of those. But on one of the homes, I didn't get my deposit back because it was after the contingency period that was in the contract, and it was not the seller's fault as to what happened. But I put down $1,000, I believe, and I ended up losing out on that money. Also, one of the other house that I did get my deposit back on, I still had already paid for the inspection on that house, which was $500. So once that fell through and I didn't get that house, I was out of pocket $500 for that inspection. So you definitely want to consider the unknowns. I wasn't aware of that, but obviously, I'm here to educate and provide you information on my experience so this doesn't happen to you. So that's as far as like pre-home ownership. Obviously, this is not all inclusive. There can be other things too, but these are some of the things that I didn't know, or some of the things that happened during the process that I think you would want to be aware. Now, post-home ownership. Okay, so like I said, of course, we know of all the main expenses that we have. Like if you're going from paying rent, you're gonna have to pay mortgage unless you were staying with somebody. I mean, it's not much difference. I mean, unless you're, gonna have to pay more money with your mortgage, it's still something that you paid before, you're gonna have to pay again. Utilities like your light bill, internet, that's a necessity these days. Most people have internet, so you have to pay that anyway. Okay, we already know all these things. But as far as like some things that you're gonna have to consider during the process of, once you've, got the house, moving costs, you have to buy a washer and dryer. I stayed in an apartment. We didn't even have washer and dryer hookup. I had to go to the laundromat. So but luckily the house that I purchased already had a washer and dryer, but some of the other houses that I looked at and was under contract on, they didn't. So I would have had to. Something to consider: refrigerator, stove, microwave. Most houses come with a microwave and a stove. I'll say a stove. Okay, a lot of like newer homes may come with microwaves. But a lot of times you might have to buy a refrigerator. Luckily, again, I didn't have to buy a refrigerator. So, gas, commuting back and forth. I moved from Florida to Georgia, okay? So I had to pack all my stuff on the U-Haul, move this stuff. That was gas money, okay? You have to pay for a trash bin. So that was a surprise to me. I got to the house and was like, well, where's my trash can? So I had to, call the company, and they were like, yeah, we can come and drop off your trash can, but that's $90 a quarter. Okay. Yes. All right. So, you have water. When I stayed in the city, okay, my water was included when I paid my light bill. So when I moved out here, my water is separate. So separate water bill. We have cleaning fees. So I had to, my auntie, luckily she came through, but I still had to pay her. I had to pay her to clean up my apartment so I could get my security deposit back. And then I had to hire on a cleaning company here at the new house to clean up this house before I moved in. So cleaning fee, yard work. Again, I stayed in an apartment. I didn't have to pay for that, but guess what? Every 2 weeks, I have to pay the yard man to come out here and keep my grass cut. So it's something else to consider. What about repairs or maintenance? Like, for instance, you need to cut down any trees that might be hovering over the house, or, I don't know, you just want to cut down some trees. What about a privacy fence? Maybe paint your home, get new cabinets, especially if you have an older house that you purchased. You may want to consider, getting, making the home homey, right? This is going to be your home, so there's some things that you may want to do. HOA, I have to pay $150 a year for my HOA. So again, something to consider. Flood insurance, I don't have to pay for that personally, but I know there's some people who do if you stay in like a flood zone. So that flood insurance will be something you have to pay for. Of course, like taxes, license, registration, car insurance, all that good stuff or whatever. So again, these are a lot of expenses a lot of us don't consider beforehand, and then we get the house and we're like, oh my goodness, like it's such a surprise, like I didn't know I would have to pay this, and then all of these things just become an issue or takes a toll on us because we wasn't aware of that. So make sure that you're doing your research in regards to where you're wanting to move, so you know the expenses that you're going to have to undertake. So once you've determined what type of loan that you want to get, you're going to start working on your credit. You've gone through the process of saving money or making sure that your money is in place. So before you even decide to apply, you would want to check the market, okay? I just don't see it making any sense that you're preparing or prepping yourself and you have no idea what type of home that you actually want. Do you want to move into a home? Is it single story, 2-story? Do you want to move in a condo or a townhouse? Maybe you want to move in a manufactured home. Like, you would want to determine what type of home that you're wanting to purchase. And some ways that you can do that is by doing research on Zillow, Realtor, Redfin, okay? Zillow and Realtor were my best friends, okay? I spent so much time. I worked a demanding job. I was working 55, 60 hours a week, and searching for houses on Zillow and Realtor was like my second full-time job, okay? But some of the things that you'll want to consider when you're searching for homes is, where do you want to live? Now, I worked from home, so the sky was the limit for me, in a sense. Like, I wasn't subject to just staying in the area that I was in. I always wanted to move away from home, so I searched high and low. Okay, I started out in like the surrounding areas near where I lived, because I lived in the city of a population of about 150,000. It was not USDA eligible, but there are certain areas that are considered to be on the outskirts of the city that may be USDA eligible. So I searched those areas, and I started expanding out to other cities in Florida, and then I started looking in the Georgia area. So if you work from home, or you say you do go to a brick and mortar building, but you have the option to work from home, then you may be able to search in different areas. And also depends on your situation. Do you have children? As I've stated, I'm a single mother of 3 kids, but my kids were a little bit older. So if you have little kids, and especially if you're still getting help from family, you might have to stay close to home, but I had the option to move away and wasn't subject to a specific area. But of course, if you have to go to a brick and mortar building and you may not be able to move elsewhere, which is fine if you're comfortable where you live and it's USDA eligible, like a rural area, then that may be fine. Or you may have to expand out in the outskirts, but you definitely want to consider where you would like to live. One thing I can say too is, I don't think all rural areas are eligible, and I say that because I was looking, I wanted to move like near the Jacksonville, Florida area, but obviously Jacksonville has a population of like 970,000, so I thought about moving somewhere on the outskirts, or somewhere that's within like a 30-minute proximity. So I thought, okay, Orange Park seems like a great place, and their population is maybe somewhere near 10,000. And as I would put all of these addresses into their home eligibility system, none of the houses were eligible, and it would say that it was an USDA eligible area. So I don't know if it's just because it was such a close proximity to Jacksonville, and Jacksonville is like pushing to almost 1 million, if that was the reason. But also when I decided to look in Georgia, there were some areas that also had a population of somewhere around 10,000. And excuse me, I guess because they were army based areas, I could not move there, or those areas were not eligible either. So there are some things you'll want to consider, but I'll read you the definition of what USDA considers as a rule. So it states any open country and places with a population of 10,000 or less, and under certain conditions, towns and cities between 10,000 and 20,000 population. So either way, you'll want to consider that information, or like I said, if there is a house that that's questionable, you can always plug it into the USDA's website and it will let you know if that house is eligible or not. But other than determining where you would like to live, you want to determine what type of home that you want, and outside of 3-bedroom, 4-bedroom, 5-bedroom, how many bathrooms, what do you want out of your kitchen, your yard, all these things I considered, because I have kids, I wanted to have yard space. Do you want a porch, or you want to make sure that you've kind of you have this pictures in your mind of what your house looks like, whether this is your dream home or this is a home that you're probably going to be living in for a while and possibly raising up kids, that you would want to put this all together of what that looks like for you. I knew I wanted a new build home, and or a house that was had been built at least within the past 10 years, because I knew that I did not have the money to put in for repairs, or to go in this house and start renovating and doing all those things. I wanted a move in ready house. So if I had to repair anything or start maintenance, or anything in that nature, I wanted that to be a little bit down the road before I had to worry about that. Now don't get me wrong, there's some newer model homes that you may have to put some work into, but it definitely decreases the chances if you get a newer model house. So that's something to consider as far as your circumstance and what your capabilities are. Okay, so you will also want to determine, again, like I said, the features that you want in your house. I've stated it, whether if you want a yard, you want a 2-car garage, whether if you want a garage or not, you can always put your carport up. You will want to really consider all of those features. And given all of this information, whether if you want a new build or already built house, where do you want to live, the features in the home, you will want to determine what the house prices look like. Once you start doing your research in that particular area that you're considering, you need to look at what are the average home prices in this area. Can I really afford this? Because that is going to determine if you're able to make that move or not. But again, if you're wanting to move into an area where the house prices are just well above your means, then you might have to basically look into other areas. So, or if you feel I'm just adamant that this is where I want to move, and maybe you try to wait it out a little bit to see if something else comes up where you're okay, I'm ready to make this move, because now I see there's something out there for me. So other than that, again, you just want to make sure that you're doing your research. You're checking the market, what's out there. So then once you get ready to apply and USDA approves you, you can hit the ground running, and once I located a house that I was interested in, this is probably my second house by this point, but it was in Georgia. I saw the house on Zillow, connected with a realtor on Zillow, and then I was able to meet this realtor in person, and then we just kind of worked together over the span of my home buying process. So whether if it's word of mouth, whatever the case may be for you, but make sure you are doing your research. Okay, so if you made it this far, this is where the rubber meets the road. Okay, if you've done the first steps, You've determined what type of loan you would like to get, and we're going to say you're going with the USDA 502 Direct. You're working on your credit, you're saving your money or getting your money right. You've checked the market. Now it's time to apply. So you're going to want to contact the USDA office that serves the county where you want to live and obtain an application. You can find this information on the USDA's website as far as the particular office that serves that county. And they should have their phone number, their email, and most likely like the I'm not sure if it's like the manager or the main contact person for that particular office, but you can then reach out to them, ask for an application. They do also have what they call a certified loan application packager or intermediary, who you can contact or get in touch with, who can help you prepare and prep your application to submit to USDA. I personally did not go through that process. I, just called the office, requested, well, actually I didn't. I called, I guess it was like the main office that I called to, get an application, and the guy emailed me like one sheet. So I filled the sheet out, and then he also provided me that contact person for the office that I, in that county that I plan to move to. And so I emailed that one sheet to that individual, and they emailed me back saying, hey, this is an incomplete application. Here is the full package. And it was quite a few pages. And then they also stated that I need to include the $25 money order or check for the credit report. So at the time when they sent me the application, I actually was not fully ready to apply like I thought I was after I went through all of the requirements. But again, you do have the option of going through the certified loan application packager, and you may want to contact that USDA office to see if there is one in your area to assist you with the process. But either way, after basically working on my credit, making sure I have my money right, all of that, from the time that I started to the time that I actually applied was about 3.5 years or so. I officially applied. That was around the beginning of May of 2021. They got back with me somewhere around like a month later, and I had all of my information together. I'm a very thorough person, so I made sure I had all of the documents and everything. It was a few things that I had to just send over for clarity, but other than that, once the young lady confirmed everything with me over the phone, she stated, hey, she's going to send over to the underwriter, and then she would get back with me to let me know the status. And I want to say she called me back within about 30 minutes and told me that I was approved. Okay, so one thing that you want to understand is that USDA runs off of funds. Okay, there is a points of time in a year where they get funding, and then they run out of funds. And even during that time when they get funding, there's people who've already applied that's kind of waiting in line, waiting for them to get funds so they can start their process. So that's definitely something that you want to consider as well. They normally get funds around the beginning of the year. And so between like the beginning to like mid-year. So you may that'll be a great time for you to go ahead and get all of your things together, have your application in, send everything over to them, so that you can get things rolling in the event that they don't already have funds. So that's something that you definitely want to keep in mind throughout this process. But other than that, the sky is the limit for you. You've been wanting to do this, you've been waiting to do it. Maybe you didn't think that you have the resources or the means, don't have the information. A lot of times we think about things from a more traditional standpoint, like getting a conventional loan, when a lot of us don't even qualify for that. But there's different options, different programs. You just have to go out and find the information. All right, my Empowered Visionaries, I know this was a long video, but I wanted to make sure I provided all of the necessary information here. But if you enjoyed this video, please make sure that you like, comment, subscribe, and share. and hit the notification bell to make sure that you don't miss any future videos. To home ownership in 2024. Peace.